Hey everybody, welcome to Money's No Object. I am your host, Dylan Howell. This is episode number 68 of our YouTube channel and podcast, and I could not be more excited to continue talking with you guys about personal finance topics that I think can be really useful for you in your long-term financial journey. Today, what we're going to talk about is this dilemma or this choice that we have, and two things that both have gone up in value over time, both have created wealth over time. And those things are stocks versus real estate. And is there one that's better than the other? What are the returns that you get from each? And how do we make this decision? How do we make this decision of two historically appreciating assets or asset classes that we know we can get our hands on as Americans, as individuals who want to build wealth in the long term? And so what we want to look at today is how are these similar? How are they different? How can we benefit from them? And then ultimately, which should we choose and why? Before we get started though, if you could go down below, hit the big red subscribe button. Also like this video, hit the thumbs up. Leave me any feedback in the comments as this video goes along. Follow me on social media at MNO with Dylan. And then check out my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can check out the types of financial coaching services that I offer and sign up for one if you're interested. If you're listening on Apple or Spotify podcasts, make sure that you subscribe to the podcast there and make sure that you leave me a review. So let's just take a broad look at this real quick. Real estate and stocks and an overview of, what are they? How have people used them? Why do they matter? Why are we even spending a whole episode on this? Well, many investors have traditionally used the stock market to build wealth. We know that. But many investors have also traditionally used real estate to build wealth. We know that too. And so we know that these are both winning instruments. We know that these are both winning asset classes over the long term. Now, that said, stocks are a very well-known thing, and they're very commonplace, and it's kind of a more attractive thing for individuals to do. And a lot of individuals don't even take into account the fact that they could purchase real estate. Not to mention, under certain circumstances, real estate could offer us lower risk than stocks, better returns, and add some diversification to our portfolio. So there's definitely benefit to be had by looking at real estate and not just stock market investments. When it comes down to it though, individuals need an investment strategy, an investment style, some way of investing that matches their needs, whether it's saving for retirement, their kids' college, whether they just want to invest for income, invest for cash flow, whatever it may be, then you have to understand that in order to put yourself into the right assets that will work with your objectives. I would say it's pretty safe to say that more individuals, probably by far, are invested in the stock market than are in real estate because it is so easy. There is such a low barrier to entry. It doesn't require a whole lot from you to open an account and buy shares of stock, but it does require a lot more from you to purchase real estate. And so I think a lot more people tend to the stock side because it's easier, but that doesn't mean that it's correct for you. If you're going to buy real estate, you're going to have money to do so, whether it's yours or other people's. You're going to have money to do so. You're going to have money to put down on properties. You're going to have money to pay the mortgage if you don't have renters in. You're going to have some cash to do these things with some way, somehow. With stocks though, it's really low barrier to entry, based on what stock you're buying. Certain stocks cost, obviously there's penny stocks, and we've talked about how those are no good, but there are stocks, that are priced very reasonably that you can buy, and their index is priced really reasonably that you can purchase as well. So it's not very hard to start with a low amount of money and make money in the stock market, but it is more difficult to do so with real estate. So when you buy stock, you're buying pieces of companies, you're buying ownership in companies, and you buy just a tiny piece, and you own that piece of the company. That's what the stock is. But when you're buying real estate, you're buying something physical, something, some property, something that you can put your hands on, a physical asset that is quite a bit different than a stock. And with stocks, as you can make money with the price of the stock going up or the firm returning capital to the shareholders via dividends or share buybacks. Similarly, with real estate, you can make money by the appreciation of the price of the property, the collection of the rents, and you also get some tax write-offs that you can count towards your returns as well. In the same way that a lot of people look at stocks as being attractive because it's so easy to get into them, a lot of people look at real estate as very attractive because real estate is something tangible. A lot of people need something tangible in order to be able to look at it and feel it and understand it when it comes to investing their money. And real estate fixes that problem pretty easily. But that said, you don't just have to invest in real estate by purchasing the tangible asset. You can also purchase what they call REITs. And a REIT is a real estate investment trust, REIT. And what the REIT is it is a portfolio of properties that produce income and that produce the appreciation that you're looking for, and it's sold in the way of being a stock. They bundle all these properties together, and the rents from the properties come out to the investor in the REIT. So quite frankly, there's just a ton of considerations that come into play when it comes to choosing, should you invest in stocks, should you buy real estate, what you should do, when you should do it, how you should do it. A lot of things come into play, and we're going to talk about some of them here, and we're going to start with the returns on stocks versus the returns on real estate. Now, just to be frank, investing in stocks makes the most sense when it comes to ways you can boost your returns. So what do I mean? Well, if you're investing in an employer-sponsored retirement account that has a match, then you're getting free money, you're getting free returns just by putting a certain amount of money in. And that's not necessarily going to happen with real estate without high leverage, and we've talked about why that is not a good idea. But those perks are not always there. People don't always have matches to run to, and even if they do, the perks are limited. And so it still puts us in a place where we don't know who returns better and why. And let's not forget that comparing the returns of real estate to the stock market is really an apples to oranges type of idea, because the things that impact the appreciation of value and the appreciation of the price of properties or the price of the stock, or the things that impact the rents or distributions to investors, those things are very distinct to those types of assets. And so it is very apples to oranges, but we'll look at it anyway. The way that we're going to go about doing this is looking at two diversified portfolios, one of which tracking the stock market, one of which tracking real estate. So we're going to use the SPY, that is the Spider S&P 500 ETF, and the Vanguard Real Estate ETF, both of these having total returns, right? So these are total return values that we're going to look at. And over the last 20 years, stocks have returned 312.2%, and real estate has returned 234.5%. Now, let's be clear. A lot of people have made those stock market returns, but a lot of people investing in real estate have also made a lot more than what individuals made in stocks in real estate. That's why it's such an apples to oranges comparison, because it's so easy to diversify stocks. It's much more difficult to diversify real estate, and you can make a lot of good choices when it comes to real estate. Now, you can make a lot of bad choices too and lose a lot of money, but it leaves there's money to be made out there in real estate if you do get good deals. And so I'm not saying that's everyone. I'm just saying on average, with a diversified group of holdings, that is what the returns have been the last 20 years. But let's also be clear to the fact that nothing is recession proof and nothing is economy proof. The prices of stocks and the prices of real estate have been heavily impacted by economic issues. So 2008, 2009, the Great Recession, we're talking about, housing prices dropping precipitously because they were a big cause of the crisis, and then stock prices also dropping very hard. But you look now during the COVID-19 crash and COVID-19 recession, then what we're actually seeing here is stocks dropped hard, and they've rebounded in quite a fantastic way. But real estate was actually increasing in prices in a lot of places because it was cheaper to borrow. Rates dropped, it was cheaper to borrow. Some people weren't affected at all by COVID-19, so they decided, hey, we're going to purchase a new house at this time. We're going to refinance our mortgage at this time. We're going to do all of these different things. So it became easier to purchase real estate. Prices of real estate went up in some places, but in some places they declined due to people leaving those areas or not being able to afford them or whatever it may be. So you have to understand that in either case, both of these asset classes are subject to being affected by big economic issues. So let's talk about some risks of real estate and risks of owning stocks. So we'll start with the risks inherent with real estate. So the most important risk that people miss in real estate is that it requires a lot of research. It's not something you can go into casually. You have to go into it with some understanding of what you're doing, understanding of the market, understanding of the location, understanding of a lot of different aspects of things in order to make really good decisions on the real estate that you buy. So there's a risk that you don't know enough and you end up making bad decisions. Then further, it's not an asset that is easily liquidated. You can't turn real estate to cash very quickly. This is an illiquid asset. Now, obviously, if it's a hot market and you put the house up for sale, you probably could sell it pretty quickly. But the time until you can actually get your money in your pocket is not near as quick as it would be if, buying or selling a stock. So there's a risk there of illiquidity. There's also risks for home flippers. So these are individuals who go in and they want to buy something really cheap, fix it up and sell it, or fix it up and rent it out, something like that. They're trying to flip houses. There are risks that come with handling repairs and managing rentals. There are big risks there. Maybe your renter does something catastrophic to your property, or maybe while you're doing repairs, you find more issues than you wanted to find. So there are definite risks in that aspect as well. And then some of the main issues that you'll deal with and that are huge risks to you as a real estate investor are dealing with tenants. So you're having to deal with people that live in your property, like I was just talking about, and then the costs associated with the property. Both are headaches. It takes a lot of time to deal with those types of things. And it just makes the barriers to entry higher, and it really whittles down the number of people who are willing to do it because those risks are inherent there. And some people just don't want to deal with the uncontrollables. They don't want to deal with things that they can't actually do analysis on and understand exactly what's going to occur. But just like anything, if you make the right decisions, do the right things, have the ability to look at history and look at how things work over time, doesn't mean you'll never lose or get burned. I mean, it's the same is true in the stock market, but it does mean that over time you would make money. So let's look now at stocks. What are the risks of stocks? The stock market is subject to several different types of risk, a few of which being market risks, inflationary risks, economic risks, all these different things. So the stock market does have its fair share of risk taking that goes on as well. Let's not forget that stocks in the short term can be extremely volatile in price. Real estate is not typically as volatile in price as stocks are in a short-term situation. And stocks can be swayed by things that you cannot control. If you can't control the geopolitical climate, you can't control the housing market, you can't control things that are going on within companies that may be unethical. You can't control those things. And so that can come back to bite you as a risk of owning stocks. Then also, stocks are highly subject to economic policy decisions. So when the Federal Reserve and the Board of Governors makes decisions about monetary policy or fiscal policy or whatever it may be, or the president changes tax code or whatever, then stocks are affected. That has been a very real concern with our current election and the current presidential race was that, are there going to be higher taxes with one candidate than the other? And if that is the case, then how's that going to affect business and the stock market overall? And then investors can create risk for themselves. Like if you fail to diversify or you fail to have any asset allocation, thus getting rid of single stock risk, then you are just creating risk for yourself that doesn't absolutely have to be there. And another risk that investors create for themselves is the emotional risks that occur. I talked in Monday's video about how would you just sell your home if you knew that the home decreased in value some because of something economic going on? Well, probably not. And so a lot of real estate investors have no trouble working through a recession or some economic issue in that way. But individuals who own stocks are far, due to the lack of friction to sell a stock and the lack of friction to buy a stock, then investors in stocks can really quickly liquidate positions and get out of stocks. But this can be to their detriment because they will sell after things have fallen. So it's much easier for them to sell, much less red tape for them to go through. Therefore, they will go ahead and do it and create that risk for themselves that they won't make the returns that they should make because they don't have the emotions, they don't have the temperament in order to invest for the long term effectively. So I decided to just go ahead and make a couple of quick lists as to the pros and the cons of stocks and real estate. Okay, so we'll start with stocks. The pros, highly liquid, right? You can buy and sell them all day long. It's highly liquid. You can have your cash in your pocket immediately. It's not hard to do. Buying and selling stocks is an easy thing to do. They are highly liquid investments, which can be a fantastic thing for an investor who wants to start or get out of a position. They're easy to diversify. You can buy stocks, some small, some large, some international companies, some dividend paying stocks, some stocks that do a lot of buybacks, some who are high growth, some who are value. You can really diversify yourself within stocks, and you can do it very easily because it's not extremely costly to do so. And then also stocks, especially nowadays, have extremely low transaction fees. You don't have to really pay for trades anymore, and that's a fantastic thing. It's very easy to get in and out. That is another decrease in friction. And then also it's easy to add to tax advantage accounts. The investing in real estate doesn't necessarily have this advantage of the tax advantaged accounts that you can easily deal with stocks in. There are tax advantages that you can have with real estate, undoubtedly, but the Roth options, being able to put money in to an employer plan and get the match and things like that, that is just not the same with real estate and stocks, and that's a really good pro for stock ownership. What are the cons? Well, stocks are really volatile. They are a good bit more volatile than real estate. Like I said, in the short term, they can fluctuate a lot. Yes, over the long term, there have been fantastic returns, but in the short term, they can fluctuate a lot where real estate doesn't really do so most of the time. Then also, selling stocks can trigger big taxes, and we don't like that either, because if your stocks aren't in tax advantaged accounts and you have to sell for some reason, or you choose to sell for some reason, then the realized gains that you have will have some type of taxes on it, whether it be individual income taxes or capital gains taxes. Then another con is some stocks just move sideways for years. Now, this is not going to be as big an issue if you're buying index funds and mutual funds, but if you're buying some individual stocks, some stocks, they just don't pan out as quickly as you want them to, or they don't increase in value as much as you want them to. Whereas, if you're constantly receiving rents off of real estate, even if it doesn't increase in value much, that the returns that you're getting can still be pretty sizable. And like I said earlier, there's this potential for emotion-driven investing, and that's going to get you in trouble a lot of times. That's what ends up causing big crashes. Like we were talking about yesterday, a lot of crashes can be caused by the quick decision by few to sell and then a bunch of people following. And being a follower and being emotion driven and seeing people selling and deciding you're going to sell too is just a way to get yourself into financial ruin for no good reason. So those are some pros and cons of stocks. Now let's look at pros and cons of real estate. So we'll start with the pros. First of all, passive income. Now, I want to get into this real quick, and I'm not going to focus too much on it because I'm going to have a video about it here in the near future. Passive income does not exist because you always have to do the work. What they mean by passive income is simply that you have income coming to you monthly that you are not going to a job for. Okay, so that's what they mean by passive income. But to be passive, is not going to allow you to make the income that you want to make. Okay, so but passive income is a pro. You have income that you're making that is not due to your job, which is a nice thing to have coming in. There are tax advantages, like I talked about previously, a lot of write-offs and deductions that you can have in owning real estate and then putting work into real estate, things like that. That's really useful. Just like stocks, they are a hedge against inflation. As the prices of goods and services go up, typically so does the price of real estate, which is very good for the real estate owner, the homeowner. And then there's this ability to leverage, which is it's a pro because you could do it, but you can leverage yourself in stocks too. That doesn't mean that it's smart. It's a pro because it's a way that individuals can fund their purchases. I get it. But it is not necessarily smart to do so. We've talked about how we want to buy rental real estate before, and we don't want to be doing it with leverage. That is not my idea of responsible investing, because you wouldn't do that with stocks. So what are some cons of this? What are some cons of purchasing real estate? Well, first off, it just takes a lot of work. It's a lot more work than buying stocks. Like I said, a lot more friction, a lot more issues, a lot more things that just come on your back, and you can't get in and out quickly at all relative to how you can with stocks. So that is a con in and of itself. It's also very expensive. Real estate is an expensive thing to purchase, where stocks can be relatively cheap, and it's illiquid. You know, you can't buy and sell really easily and have the cash in your pocket like that. You can't do that like you can with stocks. I could sell a stock now and have the cash in my account immediately, but you can't do that with a piece of real estate. And then there's high transaction costs, obviously closing costs, the broker's fee, all these different things that come in, the appraisals, everything that you have to do around real estate. It's all there. You don't have to deal with that with purchasing stocks. And then appreciation isn't guaranteed. You're not guaranteed to purchase a house in a neighborhood that goes up in value over time. Although real estate does increase in value over time, it is typically an appreciating asset. Doesn't mean it has to be. It can be in a neighborhood that, the neighborhood declines. The neighborhood becomes less valuable over time. And if that were to be the case, then you aren't going to make the money that you thought you were going to make via the appreciation of the property, but you would still be able to make the rents, which is a good thing. But you just have to know that appreciation is not a guaranteed part of real estate investing. But the good thing is that if you are good at it, if you are experienced at it, you will make sure at the buy that you should be able to see some appreciation over a certain amount of time. So two of the most common things to invest in to create long-term wealth are stocks and real estate. We've had a pretty good discussion about them. There's nothing wrong with either one. Neither one's a bad investment. I like them both. It really comes down to who are you? What do you want? What is your investment style? How do you feel about investing in certain things? What is your need? What are your goals? And you should align those with what you invest in. I really and truly think that this decision between stocks and real estate comes down to your core competencies. It doesn't mean that you can't do both. A lot of people own stocks and own real estate. That's a natural thing, but you may be leaned a little bit more towards liking physical assets, like you like taking care of it. You like being able to drive by the property and check on it. You like to be able to collect the income off of the property, even though we do like to reinvest that income. We've talked about that previously as well. So maybe you're more apt to do that. Maybe you don't trust the stock market very much, and so you just think, I would rather have this physical asset that I know and understand. That's perfectly fine. But then on the other hand, maybe you're somebody who doesn't want to put in a ton of work on your investments. Maybe you want to invest in a much more passive manner. And when I'm saying passive here, I'm meaning you're investing in a manner that is not requiring a lot out of you. So when it comes down to it, I just think this is a decision that you have to make for yourself. It's going to require some self-awareness and some understanding of what you're good at and what you like. Maybe you have only bought stocks over time and you want to dip yourself into real estate. You can definitely do that. Maybe you've only bought real estate over time and you want to dip your toe into stocks. That's perfectly fine too. But I will tell you this, the returns are going to be greatest when you're putting all of your time and effort into the things that you're best at. And so if you're best at real estate management and investing in real estate, then great. If you're really good at picking stocks for the long term, or if you're really good at, investing more and more in the stock market over the long term and getting those good returns, that's perfectly fine too. Or let's say you tried real estate investment and you're really, really bad at real estate, then you have to understand, you have to be self-aware, and based on that self-awareness, make the decision. What do I want to do over the long term? How do I want to build long-term wealth? Because we want good long-term returns, and that's going to require you to make some tough decisions. And this may be one of them, stocks or real estate. So hey guys, don't forget to subscribe to my channel, like this video, leave me any feedback in the comments if you haven't already. If you're listening on Apple or Spotify podcasts, make sure that you subscribe there and leave me a review. Follow me on social media at MNO with Dylan. And if you want to work one-on-one doing financial coaching, we can definitely do that. Just go to my website, www.mnowithdylan.com, click on the Work with Dylan tab, and then sign up for the financial coaching session type that you think you need and you think that will benefit you the most. So tune in tomorrow as I talk about individual stocks and how they're not necessarily for everyone. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.